Here's a business that doesn't post on Instagram. It doesn't have a viral TikTok. It doesn't even need a website. And yet, it can still hand its owner a six-figure income while they're on vacation in Bali. It's not a tech startup. It's not real estate. It's not crypto. It's a laundromat. And by the time we're done today, you're going to understand why some of the quietest millionaires in America built their wealth on a business most people drive past without a second thought. We live in an era where everyone wants to be a founder. Everyone wants to be the CEO of the next big app or the face of a viral e-commerce brand. We are conditioned to believe that to get rich, your business has to be sexy, it has to be disruptive, it has to be talked about at dinner parties. But let's kill that myth right now. Laundromats are not glamorous. Nobody dreams about owning one when they're growing up. You don't see laundromat founders on the cover of Forbes magazine. But wealth isn't built on glamour. Wealth is built on cash flow. And laundromats generate one of the most consistent, predictable, and recession-proof cash flow patterns of any small business in the country. Today on the Violet Vault, we are going to actually run the numbers. We're going to look at the exact costs, the profit margins, the hidden risks in the exit strategy, the way nobody does before they write the check. If you're serious about building real wealth, grab a pen and paper, because we're going deep. Let's start with the barrier to entry. A typical laundromat costs anywhere from $200,000 to $500,000 to open. That number can even push past $1 million if you are building a massive state-of-the-art facility from scratch in a high-cost real estate market. That's a big number, so let's break down exactly where that money goes, because understanding the capital expenditure is crucial to understanding the return on investment. Commercial washers and dryers are the biggest chunk of your budget. A single high-capacity commercial washer can cost anywhere from $3,000 to $15,000, depending on the pound capacity. A full laundromat needs anywhere from 20 to 40 machines. Multiply that out, and equipment alone can eat 50 to 60% of your total initial investment. But the machines are only half the battle. Then there's the build-out. This is where a lot of first-time buyers get completely blindsided. You can't just rent a retail strip mall space and drop washers in the back. You need plumbing capable of handling dozens of massive water lines, including specialized water heaters. You need industrial-grade electrical panels or massive gas lines for the dryers. You need specialized ventilation to exhaust the heat and lint. And you need specialized flooring and drainage that can handle constant moisture and chemical spills without degrading. This is not a business you casually renovate a space for. It's closer to building a small utility plant than opening a retail shop. The build-out costs are high, and they are largely sunk costs. You can't easily take the plumbing and the gas lines with you if you move. But here's where it gets interesting, and this is the exact reason serious, quiet investors love this business so much. Once that heavy lifting is done, once the build-out is finished and the machines are humming, a laundromat has almost zero inventory. You aren't buying thousands of dollars of physical goods that might sit on a shelf and expire. You have extremely simple staffing needs, and most importantly, you have predictable, repeat customer behavior. Think about it. People don't stop doing laundry in a recession. They don't stop doing laundry when they're stressed, when gas prices spike, or when the stock market drops. In fact, during economic downturns, people who can no longer afford in-unit washers at their apartments actually flock to laundromats. Laundry is one of the most recession-resistant consumer behaviors that exists on the planet. That single, undeniable fact is why this industry has quietly created more low-drama, stress-free millionaires than almost any other small business category. Now, let's talk revenue. A well-located, well-equipped laundromat can generate anywhere from $20,000 to $50,000 a month in gross revenue. That number depends heavily on your machine count, the population density of your trade area, and your pricing strategy. But revenue is vanity. Profit is sanity. So here's the number that actually matters: operating costs. Utilities, specifically water, gas, and electricity, are the biggest recurring expense. They typically eat up 20 to 30% of your gross revenue. This is why energy efficiency is so critical. Rent is usually the second biggest cost, and just like any brick-and-mortar business, your rent should stay well below that 10% of revenue benchmark whenever possible. If your rent is eating 20% of your income, the business model is broken. After you pay the utilities, the rent, the insurance, and light maintenance, a well-run laundromat can realistically hit net profit margins of 20 to 35%. Let that sink in for a second. 20 to 35% net profit margin. Compare that to a restaurant, which is sitting at 3 to 9% net margin, assuming the owner doesn't burn out and quit. Compare it to e-commerce, where after ad spend, shipping, and returns, you're lucky to see 10%. A laundromat offers an enormous difference in profitability for a business that requires a fraction of the daily management. And we haven't even talked about the hidden income streams. A smart laundromat owner doesn't just rely on the machines. They install coin-operated or card-operated soap and detergent dispensers, which have massive profit margins. They put in a change machine that charges a fee for breaking bills. They offer paid Wi-Fi, install ATMs that pay a revenue split, or even add vending machines. These add-on services require almost zero extra labor, but can easily add 10 to 15% to your bottom line. Let's make this real with a hypothetical case study so you can see the mechanics in action. Imagine an investor. Let's call him Mark. Mark finds an existing, moderately outdated laundromat for sale. The current owner is tired, the machines are 15 years old, and the store only accepts coins. The asking price is $250,000. Mark uses a mix of his personal savings for the down payment and secures an SBA 7A loan for the rest, spreading the debt service over 10 years at a manageable monthly payment. But Mark doesn't just buy it and leave it as is. Instead of building from scratch, he invests an additional $40,000 to upgrade half the machines to modern, high-efficiency card and app-operated units. These are the sleek, modern machines that let customers pay with a tap of their phone or a reloadable card, instead of digging through their couch for quarters. Why does this matter? Because the coin-to-card transition is the single highest ROI upgrade you can make in this industry. First, it makes the business more convenient, which attracts a younger, higher-spending demographic. Second, it completely eliminates the breakdown problem. In a coin-only store, if a customer runs out of quarters, they stop doing laundry and leave. In a card store, they just tap and keep going. Third, it drastically reduces lost income from broken coin mechanisms, jammed bills, and the massive security risk of handling physical cash. Within the first year of Mark taking over, the monthly revenue stabilizes and grows to around $30,000 a month. After paying the SBA loan debt service, the utilities, the rent, and a light part-time staffing budget for an attendant to clean the store and oversee machine upkeep, Mark nets around $8,000 to $10,000 a month in pure profit. That is nearly $100,000 a year in take-home cash from a business that typically requires only a few hours of hands-on management per week once the systems are in place. This is what the industry calls a semi-absentee business model. Mark can go to his kid's soccer game, he can take a 2-week vacation to Europe, and the machines keep spinning and the money keeps depositing. It's exactly why laundromats show up so often in serious wealth-building circles, even though nobody talks about them on YouTube or Twitter.
Now here's the part almost nobody mentions when they talk about buying a small business: the exit. You don't just buy a business to run it forever, you buy it to eventually sell it and multiply your capital. Laundromats typically sell for 2 to 4 times their annual net profit, also known as EBITDA. The exact multiple depends on your lease terms, the age and condition of your equipment, and the overall location. If Mark's hypothetical laundromat is netting $100,000 a year and he's kept the books clean, maintained the equipment, and secured a good lease, that business alone could realistically sell for $200,000 to $400,000 down the road. Think about the wealth-building engine hiding inside this model. Mark put in maybe 70 grand in cash to buy the business and upgrade it. Over 5 years, he took home $500,000 in cash flow. Then, he sells the business for $300,000. He has effectively created a massive compounding return on his initial investment. That's the wealth-building engine hiding in a business most people consider beneath them. And the buyer pool is huge. Often your buyer is another laundromat owner looking to expand their footprint, or a private equity firm rolling up boring businesses. But let's talk about the risks, because no honest financial breakdown skips this part. If it were perfectly safe, everyone would do it. Risk number 1, equipment failure. Commercial washers and dryers run constantly. They are workhorses. When a main drive belt snaps or a computer board fries, repair costs can add up quickly. And if the machine is down, it's not making money. If you don't have a strict, proactive maintenance schedule, you will bleed cash. Risk number 2, utility spikes. Water, gas, and electricity prices are subject to market fluctuations. If your local utility company raises rates by 20% and you haven't optimized your machines for high efficiency, that comes directly out of your net profit. Risk number 3, security and cash handling. While we talked about moving to card systems, many laundromats still handle a lot of physical cash. This makes you a target for robbery, and it introduces the risk of employee theft if you have attendants handling the vault. Proper security cameras, smart safes, and strict cash handling protocols aren't optional, they're essential. Risk number 4, the lease. This is the silent killer of laundromats. Like any real estate-dependent business, a bad lease renewal or a landlord who suddenly raises the rent can quietly destroy years of built-up profit. Because of the massive sunk costs in the plumbing and build-out, you cannot easily pick up and move. If your lease expires and the landlord knows you're trapped, they will double your rent. Furthermore, many commercial leases are triple net, meaning you are on the hook for property taxes, insurance, and maintenance on top of your base rent. If property taxes spike, your costs spike. This is why the smartest laundromat owners don't just buy the business and hope for the best. They negotiate long-term leases, 10 to 15 years, with fixed, predictable rent escalation clauses. They fight to cap the triple net charges. They modernize into card and app-based payment systems to eliminate cash handling risk. They install sub-meters to track exact utility usage per machine. And most importantly, they build cash maintenance reserves in a business bank account instead of spending every single dollar of profit the moment it hits their personal checking account. So, here is the ultimate framework to take with you today. Whether you ever consider buying a laundromat or not, these principles apply to any business you want to invest in. Rule number 1, boring businesses with recession-resistant demand often out-earn exciting businesses with unpredictable demand. Stop trying to invent a new consumer habit. Just provide a service people already need every single week, no matter what the economy is doing. Rule number 2, low staffing needs and low inventory requirements mean more of your revenue actually turns into real profit. The less complex your supply chain and your payroll, the less operational chaos you have to manage, and the higher your net margins will be. Rule number 3, negotiate your lease like your entire future depends on it, because in a real estate anchored business, it genuinely does. Never sign a short-term lease on a heavy build-out. Get options, get caps on rent increases, understand the triple net charges, and protect your downside. Rule number 4, reinvest early into modernization. The businesses that upgrade their payment systems, their software, and their equipment consistently out-earn the ones running on outdated technology from the 1990s.
Don't be the store that only takes coins in a digital world. And rule number 5, always know your exit multiple before you buy in. The sale price at the end of the journey is just as much a part of your total return as the monthly cash flow along the way. Buy a business with the intention of optimizing it and selling it to the next generation of owners. This is exactly why some of the quietest, wealthiest small business owners in America don't run flashy startups. They don't have venture capital burning through their bank accounts. They don't have hundreds of employees demanding their attention. They own the businesses nobody's impressed by at a dinner party, but that quietly deposit money into their account every single week, whether they show up or not. They have bought their freedom. So here's my question for you. I want to hear from you in the comments. Tell me, would you ever invest in a boring cash flow business like a laundromat if the math worked out this well? Or does the business have to be exciting, flashy, and innovative for you to even consider it? Let's get a debate going down below. If you found value in this breakdown, make sure you hit that subscribe button and turn on notifications for the Violet Vault. Because next time, we're breaking down another overlooked, highly profitable business model that quietly builds real wealth while everyone else is chasing the next flashy trend. Because remember, the businesses that make people rich are rarely the ones that make headlines. They're the ones that just make sense. Thanks for watching the Violet Vault, and I'll see you in the next video.